So, you've decided to start investing. That's fantastic. Seriously, it's one of the best decisions you can make for your financial future. But here's the thing, a lot of people don't talk about enough. The investing world is absolutely filled with pitfalls and traps that can drain your bank account faster than you can say diversification. It's almost like a minefield, and if you're not careful, you could step on something that sets you back years. Today, we're breaking down the most common investment traps and how you can steer clear of them. I've seen these mistakes trip up so many people, from complete beginners to even some seasoned investors who should know better. The goal here isn't just to make money, it's to the money you make and let it grow steadily over time. Smart investing is the key to building real long-term wealth. It's not about getting rich overnight with some crazy high-risk bet. It's about making calculated, informed decisions that align with your financial goals. It's about building a solid foundation that can withstand market ups and downs. By understanding these common traps, you're essentially giving yourself a massive advantage, a roadmap to navigate the complexities of the market without falling for the classic blunders that cost people their hard-earned cash. In this video, I'm going to walk you through 5 of the biggest traps I see people fall into time and time again. We're going to cover everything from the temptation of chasing those viral hot stocks to the hidden fees that secretly eat away at your profits. My promise to you is that by the end of this, you'll have a much clearer picture of what to avoid. You'll be equipped with the knowledge to invest more confidently and, most importantly, more intelligently. So make sure you watch until the end. Maybe grab a coffee, and let's get into it. All right, let's kick things off with a trap that is so common, especially in the age of social media chasing hot stocks. You've seen it. A stock, maybe for a company you've never even heard of, suddenly explodes. It's all over Reddit, Twitter, and every finance influencer is making a video about it. The FOMO, the fear of missing out, starts to kick in, and it's powerful. You see stories of people making thousands, even millions of dollars in a matter of days, and you think, I need to get in on that. I can't miss this rocket ship. It's an incredibly tempting scenario. But here's the cold, hard truth. By the time you're hearing about a hot stock from mainstream sources, you're very likely too late to the party. The big gains have probably already been made by early investors and insiders. What often happens is that retail investors like us pile in at the peak, buying the stock at an inflated price just as the early investors are starting to sell off and take their profits. This creates a classic pump and dump scenario. The price skyrockets based on hype, not on the company's actual value or fundamentals, and then it comes crashing back down to earth just as quickly, leaving a lot of people holding the bag. So, what's the solution? It all comes down to doing your own research. Instead of jumping on a bandwagon because of hype, you need to be a detective. Look into the company's financials. What's their revenue? Are they profitable? Do they have a lot of debt? What is their business model? And do they have a competitive advantage in their industry? You need to invest based on fundamentals and long-term potential, not on a short-term spike in popularity. A good company with a solid business plan is a much safer bet than a meme stock that could be worthless tomorrow. It's less exciting, I'll admit, but building wealth is a marathon, not a sprint. The second major trap, and this one is a classic, is trying to time the market. This is the idea that you can somehow predict the market's peaks and valleys with perfect accuracy. You'll sell everything right before a crash and then buy back in at the absolute bottom, maximizing your returns. It sounds amazing in theory, right? If you could do this consistently, you'd be the richest person in the world. The problem is, it's practically impossible. Not even the most brilliant financial minds on Wall Street with all their supercomputers and algorithms can do it consistently. The market is influenced by an infinite number of factors. Economic data, geopolitical events, investor sentiment, even random tweets. Trying to predict its next move is a fool's errand. What usually happens when people try to time the market is they end up doing the exact opposite of what they should. They get scared during a downturn and sell at the bottom, locking in their losses. Then they wait too long to get back in, missing the recovery and the subsequent gains. Research has shown time and time again that time in the market is vastly more important than timing the market. The smarter, more effective strategy is long-term investing, often through a method called dollar cost averaging. This means you invest a fixed amount of money at regular intervals, say, every month, regardless of what the market is doing. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer. Over time, this approach averages out your purchase price and smooths out the volatility. It removes emotion from the equation and ensures you're consistently building your positions. You simply trust that over the long term, we're talking years and decades, the market has historically trended upwards. Now for a trap that is far less dramatic than a market crash, but can be just as damaging to your portfolio over the long run: ignoring fees. Fees are the silent killers of investment returns. They might seem small on the surface. A 1% management fee here, a 0.5% expense ratio there. You might look at that and think, what's the big deal? It's just 1%. But you have to understand that this isn't just a one-time cost. It's a percentage that gets charged year after year, and it compounds against you, secretly eating away at your growth potential. Let's break it down with a simple example. Imagine you invest $10,000 and it grows at an average of 7% per year. If you're paying a 1% annual management fee, you're not actually earning 7%, you're earning 6%. Over 30 years, that single percentage point could cost you tens of thousands of dollars in lost returns. It's the difference between your portfolio growing to, say, $76,000 versus it only growing to about $57,000. That's a huge difference, and it all came from a seemingly tiny fee. This is why it is absolutely critical to be a fee detective before you invest in anything. So how do you fight back? You have to read the fine print. When you're looking at a mutual fund or an ETF, the most important number to look for is the expense ratio. This tells you the annual percentage of your investment that goes towards the fund's operating costs. Generally, you want this number to be as low as possible. Index funds and ETFs, for example, often have incredibly low expense ratios, sometimes as low as 0.03%, because they passively track an index instead of being actively managed. Always compare the fees between similar investment options and choose the one that lets you keep more of your own money. This next trap is based on a saying that's probably as old as investing itself, putting all your eggs in one basket. This is the trap of a lack of diversification. It happens when an investor becomes overly confident in a single stock, a single industry, or a single asset class. Maybe you work for a great company and decide to put your entire life savings into that company's stock. Or maybe you're convinced that cryptocurrency is the future, so you sell everything else and go all in on Bitcoin. While that conviction can feel powerful, it is an incredibly risky strategy. The danger here is obvious. If that one company you invested in has a bad quarter, faces a scandal, or gets disrupted by a new competitor, your entire portfolio could be wiped out. If the one sector you bet on, like tech, goes through a prolonged downturn, you're completely exposed with nowhere to hide. No matter how much you believe in a single investment, unforeseen events can and do happen. Diversification is your primary defense against this kind of catastrophic concentrated risk. It's the simple idea of spreading your investments around. A well-diversified portfolio means holding a mix of different assets that don't all move in the same direction at the same time. This could mean owning stocks from various industries: tech, healthcare, consumer goods, financials, and different geographic locations like US, international, and emerging markets. It also means diversifying across asset classes, holding a mix of stocks, bonds, and maybe a small amount of real estate or commodities. When one part of your portfolio is down, another part might be up, which helps to smooth out the overall ride and protect your capital from the collapse of a single investment. Finally, we arrive at the most sinister trap of all: falling for outright scams. These are the schemes that prey on people's greed and their desire for a financial shortcut. They often come disguised as exclusive, can't-miss opportunities. You might get an email, a direct message on social media, or even a phone call promising guaranteed high returns with no risk. They'll use high-pressure sales tactics, telling you it's a limited-time offer and you have to act now. They create a sense of urgency and exclusivity to prevent you from thinking clearly. These scams can take many forms. It could be a Ponzi scheme where returns for early investors are paid with money from new investors. It could be a crypto expert on Instagram asking you to send them your crypto so they can trade it for you and generate massive profits. Or it could be a fake investment platform that looks legitimate, lets you deposit money, shows you fake gains, and then disappears completely when you try to withdraw your funds. The common thread is always the same: a promise that violates the fundamental risk-reward principle of investing. In legitimate investing, higher potential returns always come with higher risk. The number one rule to protect yourself is simple. If it sounds too good to be true, it almost certainly is. There is no such thing as a guaranteed high return with no risk. That's a fantasy. Always, always perform your due diligence. Is the person or company offering the investment registered with the proper regulatory bodies like the SEC? Can you find independent third-party information about them or just the marketing material they provide? Be skeptical of unsolicited offers and never ever give in to high-pressure tactics. A legitimate investment opportunity will still be there tomorrow, giving you plenty of time to research it thoroughly. So there you have it, 5 of the most common and costly investment traps that you absolutely need to avoid. From the allure of chasing hyped-up meme stocks to the silent portfolio drain from hidden fees, being aware of these pitfalls is the first and most important step toward becoming a successful, long-term investor. Remember, building wealth isn't about finding a secret shortcut or a get-rich-quick scheme. Those paths almost always lead to disappointment and loss. It's about discipline, patience, and consistency over a long period. The key takeaway from all of this is to empower yourself with knowledge. Always do your own research. Don't just take someone's word for it, not even mine. Dig into the numbers, understand the business you're investing in, read the fine print on fees, and be deeply skeptical of anything that promises the world. Your financial future is your responsibility, and making informed, wise decisions is the best way to protect and grow your hard-earned money. Invest for the long haul, stay diversified, and keep your emotions in check. If you found this video helpful and want to learn more about how to manage your money and invest intelligently, do me a huge favor and smash that like button for the YouTube algorithm. It really helps the channel out. And of course, make sure you subscribe and hit the notification bell so you don't miss any future videos where we'll break down more financial topics just like this one. Thank you so much for watching, and I'll see you in the next video.